All right, everybody, this is being recorded. One thing I mentioned at the beginning of all of these webinars is watch it again because some of the nuances might fly by you. Yes, you can go online, figure out how to do a short call spread. That's pretty basic. I'm not going to lie to you. But when you build it, you really need to know how to implement that strategy. And what goes into that are some of the things that I talk about. And they're basically step-by-step process on whether or not this short call spread can be implemented in and around your underlying. Okay, we come up with a bearish market assumption. We need to know what's going on in that underlying and know if the short call spread is appropriate for that market assumption. All right. Without further ado, let me get a couple things actually out of the way real quick. My name is Eric Wilkinson. You may recognize me on mainstream media. They used to call me the Wolfman. I've been trading my own account since college, and after graduating college with a finance degree, I moved to Chicago, and I've been trading stocks, financial futures, commodity futures, currencies, and basically options on all these products and just about all market conditions. One thing to keep in mind that anything I talk about this or in this webinar should be considered general commentary, should not constitute investment advice. The reason why I don't give investment advice is because I don't know what's in your portfolios and I don't know what your risk parameters are. You know, we may have very different ideas as to what stock is good and what stock is bad. So I don't want to lead you down the wrong road. You might very well be right on your market assumption. All right, and please remember past performance of any trading system or methodology is not necessarily indicative of future results. You can follow me on Twitter at Wolfman's blog or our parent company at ProTraderStrat. I forgot to throw up. Oh, there's the one. And then we can look at ProTraderStrat on ProTraderStrategies.com on Facebook for market wisdom and all kinds of deals and stuff like that we throw out there every once in a while. So please check that out as well. All right, I mentioned this is on the short call spreads. And one of the things with the short call spread is that we need to have a bearish or market neutral assumption. Now, remember, last week we were talking about the short call, right? Just the short call. And you're actually able to be directionally wrong with that short call. As a matter of fact, I've proven that in some of the daily market commentaries with some of the earnings trades that I've done where I was directionally wrong on lows. I saw the Home Depot trade, right? And Home Depot took a tank. The next day, Lowe's came out with their earnings, and I played it to the downside. Again, it was directionally wrong, but was able to make money with those short calls. Now, we're doing the short call spread week. We don't have as much wiggle room to the upside with the short call spread the way that we designed this. So you need to be a little bit more bearish, and you don't want that market to really move against us as much. But you have a little bit of wiggle room, just not as much as you would with the short call. I hope they won't drop think or swim. I don't think they will, Kit. The reason why is because I think the think or swim platform is better than their platform. I think people like it more, at least I do from a floor trader's perspective. I think that they have all the things that I look for. Schwab's just, you know, and I'm biased, so it is what I have to say. But I would think that they're just going to reskin it and white label it under their Schwab and probably still call it Thinkorswim is my guess. I don't know. I'm sure that namesake would come with it. I mean, TD Ameritrade actually bought Thinkorswim and just integrated it directly as Thinkorswim. So Thinkorswim used to be its own little standalone platform, but TD Ameritrade wanted that online presence in trading. So I think they'll probably do the same thing. All right, so we got that. We got bearish to market neutral. The reason why you can be market neutral is when you're collecting a premium, that theta decay can help you. But one thing we need to make sure we are looking at is picking the right underlying. And with this, I have a couple of little simple rules to follow, and it doesn't really matter how big the stock is. It will generally follow this rule. So the easiest thing to do is to say picking the right underlying is if it is a stock that's less than $100, then we are basically looking that it needs to be about equal to or less than 10 cents wide from the bid to the offer, all right? The bid to the offer in the option montage. Now, what's the option montage? Well, if you've looked at Thinkorswim or the TD Ameritrade platform, we can go over there and, why is that popping up for me? Go over to the option montage. Come on now, work with me. Got a webinar going on. We're live here. All right, so over to the option montage, and this is the option montage. Basically, any of your platforms that have all of the strikes for the individual underlying. This happens to be FedEx, all right? So I said any stock under $100, so let's just take a look at one that is TBT, which is an ETF. It follows the ETFs as well. We could even look at Kroger, but this is under $100 stocks. And right here on the at the monies, the ones that are closest to expiration, or the ones that are closest to about 35 days to expiration, 30 days to expiration is kind of the wheelhouse to look at. Sometimes, you know, when you're at 40 days to expiration and there's another monthly that is really close, a lot of eyeballs are moving out in time already. So that's what the idea here is with this tight bid ask on the underlying, is because that's where the eyeballs are. We don't want to have to give up a lot of edge on these underlyings to, you know, get our markets, right? I don't want to have to figure out the pricing. You know, if it's 25 cents wide, then, you know, there's not a lot of eyeballs in there for one, and you're going to have to end up paying very close to the offer or the bid, which really isn't going to be fair market value for the most part, because, you know, when there's good free market price discovery going on, there's a lot of eyeballs, like I said. And what happens is if somebody comes in and offers a little bit better, say for instance, you know, it's 90-cent offer and I come in at 89-cent offer, well, all of a sudden that person that was at 90 cents realizes he's off the market. He's not being represented anymore and might offer 88s or 87s or something like that. May even just join my offer. But the fact of the matter is that free market price discovery in the auction, everybody wants to get their market represented. So that's when there's a lot of eyeballs, the markets get really tight. So a stock less than $100, we need to make sure that the bid offer is less than 10 cents wide. If we're looking at something that's over $100, let's look at Deere. Then the idea here is that we're just going to move the decimal place a couple of ticks to the left. So it's right here. We're just going to go 1, 2, 3. And basically that makes it 17.5 cents, right? So that's what we're looking for. So we take this and Deere and take a look down here at the option montage and make sure that it's fitting that rule from the bid to the offer. Now this is during open market operations. You can see on some of them they're fitting, but other ones they're not. Deere usually has the eyeballs in there during the open market operations to fit that rule. So make sure you're looking at that to follow this. The volume and open interest is something else you can look at. You know, just look to make sure that most of the strikes just out of the money have a lot of trading going on, and that will kind of tell you that there's also a lot of eyeballs, because once you put on a trade, right, you're keeping an eye on that trade. So the idea is just make sure that there's a lot of people trading that, and therefore there's a lot of eyeballs on that. So we just move that 3 ticks to the left, like I said, and make sure that it fits that rule, you know. As a matter of fact, if it's just outside of it, like if we look at Biogen, which is one of the stocks that I kind of look at, you can see that if I move the decimal 3 ticks to the left here, it's 28, 29 cents. And these look like they're 60 cents wide. Well, during open market operations, I was even looking at it today. And as I was vetting it, it was just slightly wider than that. They were about 35, sometimes 40 cents wide, but 30 to somewhere between 30 and 40 once you kind of went out on the line there. But, you know, that just keep in mind, if it goes outside of my parameter, when we're talking about things like this, you're going to hear me talking about, you have the whole stop sign thing, right? You got your red light, yellow light, and a green light. So if it fits my rule, then it's obviously a green light. If it's just slightly outside of it by a couple of pennies, you would look at it as a yellow light. And if it's, you know, much wider than that, just say it's a red light. It's just an underlying that you wouldn't want to trade, okay? Biogen during open market operations, pretty close to that. And I would say it's generally speaking a yellow light. If everything else falls into place, then, and you don't have too many yellow lights, then I would say that the trade would be able to be implemented. If you get too many yellow lights or even a red light in there, then I would say that I would pass and move on to something else that has a better opportunity and options. All right, so that's picking the right underlying. If we go over and pick the right strikes, with this one, we're going to have to start out with basically a 36 delta. And I'm going to say 36-ish delta. And the reason why is that's basically a half of a standard deviation. All right, when we were looking at just the short call, remember we were going all the way out to a full standard deviation out. Well, with this one, because we're creating a call spread, if we did this one standard deviation out, we wouldn't be collecting any credit for it. You know, you might only be getting 10 or 15 cents or something like that for the spread. And it's really just not worth the risk reward, right? You want to risk 15 cents to lose 85 cents on a dollar wide. It just doesn't make sense. So we need to make sure that we're collecting a decent enough credit. And basically that 36 delta is about a 65 or what is that? It's 36% probability of being in the money, which equates to about a 64% probability of being out of the money. So that's pretty good probabilities when we're doing that. A lot of times, though, we might have to move slightly inside of that with a slightly higher delta. But ultimately, we want to make sure that we are collecting 1/3. We want to, 1/3. We want to get 1/3 the width of the spread. All right. We want to collect. All right, we want to collect 1/3 the width of the spread, or, you know, so a dollar wide, if it's a dollar wide, then we're collecting 33 cents. All right. And then, you know, therefore we kind of move it all the way up. All right. Oh, and the other thing I want to mention is because it is 36-ish delta, let's say, and we're having a 64% probability of success on that, right? 64% probability of success, of winning, right? All right, let's take a look at the standard deviations here. Last week, I had a different chart up here, but you can see that we were looking at, those are the puts, and these are the calls. That's one full standard deviation. We're going to be looking at the half standard deviation, which is just slightly inside of here, which means probabilities of going out here are about 36%, but the probabilities of the market being on this side of the coin is about 64%. So pretty good risk reward. It's better than 50-50, obviously. You know, if you pick a stock, if you were to buy or sell a stock based on your assumption, that probability of success is 50-50. So we have turned the table slightly in our favor here. Another thing we want to make sure of is we want high volatility. And I haven't talked about that yet. That's going to be further down the road on environment. But I'm going to mention it a little bit here. When we're doing this, we're having positive and negative skews here, all right? And what happens is that bell curve that we were looking at was pretty even. Well, when there's a lot of put buying, we get negative skew, and that's to the put side. And then if there's a lot of call buying, it's skewed to the other side. So we'll see the calls maybe be worth more or cost more, the value of those strikes, further away than what we would see on the other side. So we can look at this. If we look at Chipotle, it's 532. So what we're trying to do here is that landed right in between the 530, or let's just say the 530s are the at the money. It's basically right in between the 530s and the 535s, right? So if we just went one strike out of the money and we look at the 525s, you can see they're 24.60 at 25.20. All right, let's just look at the strike that's just one tick above the 35s. And you can see that those are, what is that? What did I look at? The 30s to the 25s, and these are to the one tick away as well. So let me pull up my pen here so we can just get a better look at, a better visual here. You can see that there's the equal distance. If we looked at right in between these two as being where the market is, right? So I'm skipping this and I'm going to look at the 525s. And they are basically right in the middle. Let's just call it $25, right? Now, if I go just to the 240s, you can see that these are worth slightly more, right? And we could easily say that the market is slightly further down there, but you can see that there is call skew here. They're equal distance away. The 540 strike and the 525 strike are equal distance away from where the underlying is currently trading, but the calls are more expensive. That's where we see that skew. There's always a skew, usually one way or the other. Generally speaking, the skew is going to be to the put side, which, you know, this is a pretty neutral skew here in Nvidia. And listen, these are old. Nvidia and Chipotle might not be trading at these same prices and likely are not. But these were old examples that it's hard to find perfect examples, you know, every given week. And when I find them, I kind of hold on to them. So again, we're looking at this being the strike is the at the monies are right here at 145, right? So if I go down and look at, let's just say $10 away, we can see that the 135s are $5.35. And if I go up to the calls, you know, equal distance away, slightly cheaper. All right, so skew is to the downside. If I just looked at one tick away, those are 520. Those are pretty close, but you can kind of see where I'm getting at here. If you start going further away, even one tick further out, the 160s versus these, you can see those are 185 versus 180 to 190. So a slight skew to the put side, or slight skew, but we could almost call that pretty even, right? A nickel here or there, you start getting in between. That's pretty neutral, actually, all in all. And then we go over, start looking at put skew, just to give you more examples. We can take a look at where the underlying's trading, 210, and then come down here. So these are the at the monies here. If I go one tick away for checking out the puts, we've got right there at around 280, we would call it. Maybe let's just say 280 is what those are at. And then go one tick above, you can see that those are a lot cheaper. So skew to the put side. So that's what makes that bell curve back and forth on that. Can you look at the put call ratio to get the same information? Yes, you could look at the put call ratio to get the same information pretty much. But what we're looking at here is just kind of, you know that if you got call skew is where I want to really go with this. We kind of want to go for that, look for that, excuse me. Look for that call skew. I mean, if we get that call skew, we can actually get even a little bit further away is what I want you to take away from this. So just when you're building this strategy out, whenever you're doing the short call spread or the short put spread, just kind of keep in mind that there could be some skew there. Some of that has to do with a bullish bias. Usually a call skew means that there is a bullish bias. There's more call buying going on. And if there's put skews, there's more of a bearish bias out there, which means there's more put buying going on. To me, I don't care what everybody else's bias is. At the end of the day, I'm looking at the probabilities of success, and the probabilities are the probabilities. And in this case, like I said, we're going to be looking at that call skew, and we'd be looking at the 136 calls, which gets me a little bit further away. The probabilities are the probabilities. So that's what we would be looking for. All right. And the duration, because we're collecting a credit, we want short duration. So we're going to be looking at getting inside of 35 days to expiration. All right. That's the sweet spot. Basically, my rule here is going to be, we want it to be somewhere less than about 45 days to expiration. All right. The reason why I would be willing to go out to like this 45 days to expiration is because right around this 45 days to expiration, there is basically another one that's kind of landing inside here. You know, you're going to have about a 10-day to expiration, which there's still going to be a lot of eyeballs on there. That'll be the other spot month, is, you know, or main month. And I don't want to get involved this close to expiration. Yes, there is a lot of theta decay going on. You're just not going to be able to get very much premium for that. And I would rather get further out in time, get further away from where the underlying is trading, because you're going to be able to get that move a little bit faster. Plus, we're talking about environment. With that environment being added in there, that environment is going to be talking about implied volatility. So when we're talking about environment, I mean implied volatility percent. And volatility affects the further duration options more than those closer duration options. Yeah, theta's in there, but theta's kind of already eaten away at our premiums to a point where, yes, there is a lot of theta decay going on here, but remember, 50% of our drop in premium happens right in this area here, all right? So that is what we're trying to accomplish. Yes, these are at the monies, and we are looking at a 36 delta, which isn't necessarily the same representation. What I want you to take away from here is you can see that further out in time, you don't get that much theta decay happening, but it really starts ramping up inside of this 45 days, and especially inside of that 35 days. So that's kind of where we want to get involved. You know, if it was 14 days to expiration, I would probably, you know, if that was the spot month, I'd probably again be looking out closer to the further duration options, because I want to get that premium. I want to get further away. That then you get that quick move, your directional assumptions right, you'll be able to get in and out of this trade rather quickly, right? So picking the right environment when we're talking about that. IV percent, we want for a stock, we want this IV percent to be greater than a 50%, all right? For ETFs, we want it to be greater than 30%, all right? Now, if you are newer to this, what is IV percent? Basically, what we're going to do is we're going to look at implied volatility for a given underlying, because every underlying's going to have a different implied volatility, all right? You know, a 45 IV is really low for Tesla, but that might be really high for something like Kroger, all right? So just implied volatility doesn't tell us enough. All right, what we need to know is implied volatility at 45 high for XYZ stock? Why? Because if it is above 50% here, or above for an ETF 30, then we know that those premiums are expensive. And if those premiums are expensive, we don't want to buy when it's expensive. We want to be selling that premium when it's expensive, right? If the premium is really cheap, then we look at premium buying strategies. So for this one, we've got a directional assumption where we are bearish. Our directional assumption, we expect XYZ to go down, right? We looked at that underlying, it checks off that. We've looked at the strikes. We're looking at around that 36 delta. The duration, we were kind of looking at the sweet spot, 35 days to expiration. And in our environment, we're looking at an IV percent of above 50. So the way, if you don't have Thinkorswim, and I think basically everybody is coming up with the IV percent at this point. But if you don't and you just get implied volatility, then what you need to do is take where the current implied volatility is and subtract that by the low implied volatility. All right. You take that sum and you divide it by the high implied volatility minus the low. And if, listen, you don't have to get it exact. Again, if it came in at let's just do it this way. If it came in at something between I would say, 40, let's just say 42 to 50, that would be one of your yellow lights, okay? You would have to expect volatility to be going down or coming out of it further in order to do this. That's going to have to be part of your assumption is, yeah, I think that this market is going to slowly trickle down. Implied volatility is going to continue to come out. Maybe they just came out with earnings and you expect volatility to continue to go out for the next few days or something, and you've got this bearish assumption with it. Just know that if it came somewhere in there, then I would be looking at that as a yellow light. If it's below 30, then that's a screaming red light unless it's an ETF. Now, it doesn't mean that you get implied volatility at 100%. It can't go higher. Just know that that's what the products with this mathematical problem is. Think about the current. If the current was the high and tomorrow it upticked, well, that current is still the high. All right, so it's still 100%. And if volatility upticked, you can still get that. Same if it's the low. It's 0%. Well, if it downticked a little bit more, it could still be 0. So, but one thing to know, you do have the luxury of knowing that when we're looking at this, if we go over to the chart, you can see that we have basic, areas where the market wants to stay within. So this is something where, in Biogen, it's getting a major spike right now, which is kind of an outlier. Maybe they have a drug trial coming out or something like that. It probably was just because of that big drop right there. But the fact of the matter is they will, generally speaking, stay within somewhat of a range-bound area. You can see this is what I was talking about. Ulta, for its earnings, usually only gets up to about 47. Well, right now it's slightly higher than that, probably up at around 49, right? Well, if tomorrow it goes to 50, well, that's still going to be in the 100 percentile for implied volatility, all right? So the idea here is, though, that we can see that when Ulta gets this high, usually we can expect volatility to soon come out. Well, yeah, they have an earnings coming very shortly. So, volatility in and around the retailers in general is kind of spiking right now because everybody's coming out with mixed signals, but we're getting some higher volatility there. But you could expect that it's going to slow down a little bit of that momentum because it is near its normal highs, right? But what I'm saying here is that when it's trading at 50 right now, or when implied volatility for Ulta is at 50, we know those premiums are the most expensive we've seen in Ulta the entire year, right? If I go over and look at something like Tesla, it's always a great example for volatility. But I go over to Tesla and you can see, when it gets down around 50, and of course it's gone a little bit lower, but when it gets down to 50, that's the very cheapest you're going to see, or some of the cheapest premiums you're going to see in Tesla. It spikes all the way up to 80. So that's why I'm saying you can't just look at 40 or 41 and say, oh, well, that's what we're looking for implied volatility. No, we need to know what implied volatility for that underlying is. You can see here, Costco, when it's at 30, that's expensive. The premiums are the most expensive you will see, usually speaking. And then, 13 for implied volatility is pretty low. That's why we need to come up with this fraction in order to determine where we are now in relation to where we were in the past. So, you know, you can just look at, you don't always have to come up with the chart and know exactly where it's at, but, you know, and do that mathematical problem. You just know that when we're kind of in the upper bounds, you would know this is kind of the idea. Well, this would be a definite area to start selling premium because that's in the upper reaches of where it normally goes. Right here, I would probably look to figure it out. Obviously, it comes in right there at 48. You know, then if we were looking at a premium selling strategy, we felt Costco was going to roll over, then, you know, that would be one of those yellow lights. We'd have to look at everything else to see if it falls in line with my rules during the open market operations. You know, like, it's a $300 stock, move the decimal 3 ticks to the left, 30 cents. Does it fit that rule, 30 cents? Even after the close, Costco's making sure that it fits that rule. And you can see there's some pretty decent volume, some good open interest across the board on these expirations that are, you know, closest to that 35 days to expiration. All right. Everybody with me so far? We're going to go through some examples here in a minute so that you guys will be able to see as well. What happened there? Can you guys see that screen? There we go. So picking the right environment, we've got that, right? Implied volatility over 50 for a stock, implied volatility percent over 30 for an ETF. All right, our exit strategy. Now, you know, with this one, I usually talk about getting out at 50% of your max profit. One thing to note with this short call spread, I am probably going to play this out for a full loser on the exit because it's a defined risk strategy. I'm collecting a third the width of the strikes. So, you know, we're risking 2/3 the width of that strike. But to get out of this, I'm looking at getting out at, if you are newer to options trading, 50% of max profit. And if you are a little bit more risk tolerant, I would look at 75% of max profit. But for this, I'm going to say we're looking at getting out at 50% of max profit. Now, if you're looking at those dollar wides, you know that we're only collecting 30 cents, you know, and it used to be very difficult to really want to get out at 50% of max profit. You're only collecting 15 cents or something, and then you had commissions. But now we don't have to worry about commissions so much. 50% of max profit is a nice win on this. So do that. And if you have a higher risk tolerance, then we're going to be looking at a little bit more. Probably, you know, I would say probably closer to 75, maybe 60% of your max profit there. But one thing I talk about also is when you're going through this, right? You've come up, we have XYZ, and we think that XYZ is going to go down, all right? Well, thing we have to figure out here is we're bearish on XYZ. I need to know if XYZ is a good underlying for options. So check, you know, write this stuff down, make notes of it. The reason why I say write it down is because you stick to it when you write it down. If you just have it in your head, especially where your max profit is, you might have a tendency to bend the rules. When you put it down on paper, you're kind of holding yourself to what you said when you started setting this up, and it keeps you mechanical. And one thing I mentioned is being mechanical takes the emotion out of trading. And the hardest thing to do is take that emotion out of trading. Why? Because money is an emotional, there's a tie to money that's emotional, and we got to get rid of that. All right. So the idea is write this stuff down. It keeps you mechanical and you stick to it. You'll go back there and look at it and see that these are the thoughts that you had when you set it up, and then you want to stick to it. All right. Write down your strikes so you can keep track of how accurate you've been. Duration, and especially the environment. If you start checking all those things off, put them down on paper, then you will get a better visual of it, and you are more likely to stick to it. But definitely write down your exit strategy, okay? Put that down on paper where you're getting out of this trade, because I've seen it time and time again where people say they're going to get out at a certain place, and when that happens, they don't get out, and what it turns around on them. All right, because it's a premium collection, our max profit is the premium we collect. Anytime you're selling premium, 99% of the time, that premium is what you can collect. Butterflies have a different beast sometimes. All right, your max loss is the long strike, the long call strike, minus the short call strike, and minus the premium received. So basically, it's the width of the spread minus the premium received is the simple way to do that. And our break-even point is that short call, right, which is closer to the at the money, our short call plus the premium received. Anytime your premium received, that kind of pulls us further away from where our short strike is, all right? So it's the short call plus the premium received to the upside. All right, this is where I throw it out to you guys. If you guys have some stocks you want me to look at, we'll vet through those to see if they fit the rules. Costco, and another thing I mentioned is we don't want earnings in this option cycle that we are getting ready to put a trade on around. So as we'll see here, Biogen. Now, Biogen is one of those yellow lights, but, Costco, I think, has earnings coming up soon, and they do. So in the option cycle, we're looking at, we're going to be looking at this option cycle right here. So we've got an earnings in there. I wouldn't want to implement this strategy for earnings, especially this far away. I have specific rules for earnings trades that are a little bit different. So make sure you check those out. I have courses on earnings that even set you up for future earnings trades as well. But for this one, we want to kind of stay away from this kind of trade where you have the earnings in there because anything can happen. The market can move ahead of that and throws off where my strike location is for an earnings trade if I have a bearish or bullish assumption. So I would hold off on that. But because you can see all we're having is pretty much yellow lights, we can look at Exelon. Let's say we got a bearish assumption in Exelon. They don't have earnings coming up. Go over here. It's under $100 stock. So we're going to be looking at the 29 days to expiration. You can see it doesn't really fit that rule all the time during open market operations. It does sometimes. There's pretty good open interest, not a ton of volume going on though. But for the sake of looking at this one, you can see, we don't have that 36 delta. So the thing is, we're going to have to go a little bit closer to the at the money and try and figure it out, see if a dollar wide gives us 33 cents. So a lot of times it won't give you the exact strikes. Now you might be saying that's pretty darn close to the at the monies for my type of spread. So I don't think I would want to do this. Well, then maybe you want to be looking at, for that 33 cents, just selling the 46 calls, then go to my call rules and see if it fits that, for a short call, because, your probabilities versus your risk might be a little bit better here. Cisco, I see somebody throwing up there. Let's check out Cisco. See what Cisco looks like. Let's just go over to the charts real quick and see. Cisco doesn't have earnings coming up because they just had them. Now, if you really expected volatility to come out, and Banu, I know that you're looking at this and you've watched several of my videos and stuff like that. You've been around for a little while. That would, to me, almost be a red light on how low that volatility is. If I had a bearish assumption in this, I would almost be out there buying a put or something like that. So I'm going to say stay away from it, despite the fact that Cisco fits the other rules, tight bid offer, has a good duration there and stuff like that. But if you're selling the calls, you're going to basically be selling pretty close to where they probably traded yesterday. All right. So I'd pass on that one. Qualcomm. So Qualcomm, we can take a look at. Let's go over to the chart and see. It's got volatility really low also. It doesn't have the earnings coming up. But again, you may very well have that bearish assumption, however you came up with that bearish assumption, that it's going to come back down. Again, this one is another one where I would be more inclined to buy puts in there because, you get that market move in your direction, then, you get that sell off. Well, you could very easily see the volatility rise. Well, you get double bang for your buck in that regard because volatility is increasing. You're getting your directional assumption right. Well, then those premiums really start pumping up rather quickly. So again, I'd stay away from Qualcomm, but I'd look at something else for that. All right, Apple. Another place, if you're on Thinkorswim, you can see it right down here, IV percentile. I don't know about most other trading platforms, but immediately we can see it's not fitting that rule. It is below. And again, this would be a situation where I'd look at the rules for a bearish assumption with a really low implied volatility. All right. So, so we don't keep looking at bad examples. We'll just go and look at, we're going to have to look at one of these that has close to, where's FedEx at? Did FedEx fall off the cliff with the premium? Because I was vetting FedEx for this. Oh, there it is. Oh, you know why? Because it's got earnings. All right, so let's just look at FedEx. Pretend this chart is right and there's no earnings. I know there's earnings in there, you guys. But I want to come up with one where we can get the right premiums, all right? So what do? We go and look at the ones that are 36 delta. Now, with this strategy, we are usually not going to be able to go further away. We're going to probably have to go closer for this strategy. So let's look at the first thing we do is it the right underlying? FedEx, it's $150 stock. Move the decimal 3 ticks to the left, 15 cents. Come down here during open market operations. You can see they're not fitting that rule right now, but make sure it fits the rule during open market operations, which I'm going to say it does. And we're going to sell the ones that are slightly in, right? So the 157.5, just go one strike out, and we are $2.50 wide. Now, the other thing we can do is take a look and see if it's a third the width of the strike. So we take 81 cents and divide that by the $2.50, and we get 32. I said third the width of the strikes. That's pretty close for government work. I wouldn't even say that that's a yellow light because it doesn't get that extra 0.006% in there, or 0.006 of it percent anyway. Or actually, it would be in percent. It would be 0.1%, I suppose. 0.6%. So I would say that one would work. All right. And then we would be looking to get out at 50% of max profit, which is when it's trading 40 cents. That's what I would write down. When this underlying is trading 40 cents, we would look to get out of that. What's Lulu doing? We'll check out Lulu. And 52. All right. So assuming Lulu doesn't have an earnings in there, all right, I wouldn't implement this tomorrow because I believe that their earnings are landing like right around in here. We can pull up a different chart. Take a look at that. So again, we do have the earnings coming up. I wouldn't implement this far ahead of time for that earnings. But for sake of looking at Lulu, let's say, all right, I've got a bearish assumption. I know there's no earnings in there. I'm going to move the decimal 3 ticks left, 21 cents, go to the closest to 35 days to expiration. We can see that 21 cents It doesn't fit the rule here, but I know during open market operations it does. So let's assume we're looking at this during open market operations. It fits that rule. All right, 36 delta. It's 37 is pretty close for government work. We're going to have to move inside though. We're going to sell the 37s and then buy the, sell the 227 and a halves and buy the 230s, 82 cents. We know that that from the last example is probably a little bit better and fits that rule on that. All right. So if you had a bearish assumption on this, no earnings, 35 days to expiration, for sure, I would look to do this. You could even look at it if you wanted to get a little bit more credit for it. You have a little bit higher risk parameter, go to that one and see if the $1.57 fits the rule. If you can go a little bit wider, it's not going to, I can tell you right now. So $1.57 divided by the $5 wide. And it's pretty close. But for me, I'd probably go with that a little bit tighter and go with the 88 cents. Or the 81 cents, I'm sorry. If you don't have a good choice for 35 days out, do you go out another month? Yes, if it is, for instance, when these are trading at around, when we have these options are trading at around 15 days to expiration, you are probably going to be right in this wheelhouse. But if it's like, 20 day, less than 20 days, then I'm probably going to roll out closer to that 45 days to expiration. All right. So this is, inside of that 35 days. It's basically the idea is look for the closest duration to that 35 days to expiration. Goes inside of 20 days, then yes, that's probably where I'm going to be looking to roll out. And yes, somebody asking, can we use the weeklies? Yes, you can use the weeklies. Just make sure that they have tight bid ask, especially in these options closer to the 35 days to expiration. A lot of times then those weeklies will, but just know if it's not fitting that rule of the tight bid ask that we are looking at something that is becoming a yellow light, okay? So yes, you can use the weeklies. I have no problem with that. Trying to see if there's any. So TLT fits the rule for being an ETF above 30. So we can take a look at this on the charts. You can see it's above 30. We've been getting some rally on this TLT, but it could be considered to be a little bit overdone to the upside. So let's see, it's $139. So 140 is about 14 cents wide. All right, it fits that rule. 36 delta is pretty close. So I'm going to just see if this works on the 36 delta. I want to at least be $1 wide. So you can see $1 wide is not fitting that rule again, even though it's very close. So we're probably going to have to go just inside of it and do $1 wide on that. And you can see that then fits the rule. So always probably going to have to roll just inside of that 36 delta for this to really work out on that. All right. All right. Well, without further ado, then, you guys, hey, this is a great deal. You get 4 courses here. This plus you're going to get access to all kinds of other content as well. So we've thrown in extra content for this one. Let me pull this up over here. This link is over there in the chat window. We've been going back and forth in the there it is. I just sent it out to you guys all in the chat window. That's a hot link right now. If you're watching this on tape delay, you're just going to have to pause and type this into a URL. But you're getting all of these options, option courses, not just 5. There's not just 5 in the volatility crush, and these particular ones for the floor trader hacks, which will allow you to save time, plenty of time. The volatility crush will streamline your process, allow you to sleep at night. Hacks is going to speed up all of your thought process when you're finding in the money, out of the money stuff, what the intrinsic, extrinsic value is. I show you how to do that real quick. Probability of your trades, all of those, the option basics, some fun ones like the history of options is a great one. How did options get started? Who was the first person that thought of it? It's pretty interesting. And how to trade like the Wolfman, basically setting up my option screens. You see that happen. You've seen me set up my watch list a little bit differently, and even my charts. So all of that stuff is basically on sale right now for $297. Take advantage of that. Plus there's, what was it? If you get it right now, you're getting access to over 50 recordings from the Lessons Vault. So take advantage of that. Yes, it is a little bit more expensive than some of the other ones, but you're getting enough content that will take you into at least the summer, and that's if basically you're watching 1 or 2 videos a week. So take advantage of that, because this is one of the best deals. You're basically getting all-encompassing and should be able to trade options quite easily on your own after watching these. Plus, you can watch them over and over again. You get access to all of these, and you can take advantage of it. So if you like the way I teach, yes, it's not necessarily free, but for $297, and you get all of this content plus 50 other videos and lesson contents that we haven't listed on here. All of that for $297 is a great deal, and it will carry you for a very long time, and you'll get, all kinds of premium access to stuff that most other people aren't getting access to. All right. So if you have any questions, you can reach out to us at 310-598-6677, or you can email me at trading@protraderstrategies.com. And one other thing I think I see a question coming out real quick. Let me get over this real quick. Other webinars, I'm going to be drilling on different option components when and where I find those appropriate. Also, here is that, that's the wrong link. The link is in the window, or this is the right link right there. Options trading course sale. So make sure you pause if you're watching this on tape delay. If you guys are watching this right now live, hit that link and take advantage of this, all right? Plus you get the 50 other videos coming out. So I'll pull that back up so you guys can take a look at that as well. Blow that up. So make sure you take advantage of this. All 4 courses today for $297, and you get the bonus with the Lessons Vault, all right? So right there's the URL. You'll have to, like I said, pause it and type it into your platform if you're watching on tape delay. If you don't have a good choice for the 35 days out, you go to another month. Oh yeah, I think I answered that right. If it's, inside that 20 some days, then take that. Cool. All right. Thank you guys for your kind words. And again, if you like the way I teach, if this stuff makes sense a little bit more than going on Investopedia and just looking at how to sell a call spread, they aren't giving you strike locations and all that stuff. They aren't talking about environment. You know why? Because they don't understand it. Even the guys on TV, yeah, that's free. But those guys, tell you about unusual option activity, and then they'll tell you to go out and buy a call in high volatility. Well, I've shown in my daily market commentaries, you guys, that that is not the best practice, because you can be directionally wrong the way I do it sometimes and still be right. All right. Take care, Rick. Thanks, Chris. Appreciate it. Appreciate it, Phil. All right, guys. If you can't take that, take it easy.